very warm welcome, everyone. My name is Nicholas Tan from Kenanga Futures Sdn Bhd. Thank you for spending your precious time to join our webinar today. It's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivatives to the participants. We have returned with our nationwide campaign Into the Futures. Stand a chance to win prizes worth up to 30,000 ringgit when you trade Malaysian, US, and Hong Kong futures contract from 1st August 2020 until 31st October 2020. Please take note that futures and options trading involves substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes. Kenanga Futures Sdn Bhd accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. Before we start, we would like to take this opportunity to invite you to Kenanga Futures' next webinar on 29 September. It's about climbing the wall of worry to new height or an abyss. An invitation email will be sent to you. Don't miss out. Please register once you receive the email. Next, if you have any question for our speaker, please feel free to post your questions through the Q&A box on the right side or at the bottom of your screen. He will attend to your question after the presentation. Today we have Mr. Edwin here, and he's going to share with us, let's learn about futures. So without further ado, I would like to kickstart our webinar by welcoming our speaker today, Mr. Edwin. Edwin, over to you.
Hello, good evening, ladies and gentlemen. First of all, I would like to thank you all for taking the time to join us for our webinar today. Just a brief introduction about myself. I'm the Sales and Dealing Manager for Kenanga Futures. And I will be sharing, the topic for today will be, let's learn about futures. So I assume that most of the people that are listening in are new to futures and would like to learn more about the derivatives market. Okay. So I shall begin basically by showing you the list of agendas for today. But essentially, there will be three main takeaways, which I will be sharing with you. Basically, what is the futures contract? And then some basic trading strategies on how to trade these the futures products. And thirdly, will be the risk management aspect of it. How would you actually manage your risk when you are trading with futures? Okay? Just a quick disclaimer. So my talk basically is just for information purposes. In no way are we like asking you to or giving you trading strategies to execute on the market itself. Okay, so let's begin. So the first area which I would like to cover is basically an introduction to the derivatives. Okay, what is a derivatives, or you can also say what are futures to explain further on this. Basically, derivatives is a financial instrument that is used to manage portfolio or the instruments exposure in volatile markets. Initially, futures or derivatives was introduced in the commodities market for a way for what we term as physical people to actually hedge their position in the physical positions in the futures market. Okay, all futures products are derived from an underlying asset. So what a lot of questions that I get is when people ask me, what do you mean by underlying asset? So basically, for example, if you trade like a product, say like crude oil, okay, so the crude oil futures, the underlying product is actually crude oil itself, means the physical crude oil. Okay, that would be an example of a commodities product. Whereas if you are trading in indices like Dow Jones futures, the underlying asset will be Dow Jones itself, the cash market. Okay, so when you are trading the derivatives, it's basically the contract will be linked to the expected price fluctuations of that underlying asset. So basically, you're anticipating whether the market will go up or go down. If you are bullish, obviously you anticipate the market will go up, so to speak. And subsequently, if you are bearish in the market, you would expect the market to retrace or come down. Okay, so the derivatives is basically regarded as a tool for hedging, speculating, and arbitraging. Okay, I will touch more into these three terms of trading in the further slides. But in essence, I will move on to the next slide. Okay. What the products which I are covering today are basically listed derivatives. So basically, all these products are listed on an exchange, and they are regulated by a government body, so to speak. So for illustration purposes, I will go on to, okay, for if you are trading into US products, their regulators for derivatives would be actually what we call the Commodities Futures Trading Commission, CFTC, and other regulatory bodies which are involved are the SEC, FINRA, and NFA. So as you can see, the point of me illustrating this slide is basically to show you that the futures market itself is regulated. Okay, so this is the government bodies, so to speak, that actually monitors that there is no fraud, manipulation, and make sure that the best practices are in place for participants to trade into the futures market. Okay. Next, that was the regulator. Now moving on, we'll talk to the exchange itself. So exchange is basically where the products are listed. So as an example, we are using a Chicago Mercantile Exchange, CME. So basically, they offer a wide range of products of all the major asset classes, from interest rate, equity indexes, foreign exchange futures, energy, and so forth. Okay. So the platform which CME uses is called the Globex platform. It's basically a electronic platform that runs, I would say, almost 24 hours. Okay. And all the clearing and settlement is all done by the exchange through their clearing house, which is CME Clearing. And under CME, there are basically, I would say, four, not exactly sub-exchanges, but there are four divisions. So we have the CME itself, CBOT, NYMEX, and COMEX. Basically, they look into, there was a merger between these four exchanges to form the CME group, and they basically specialize in different asset classes of trading futures. And moving on, now, what is futures itself? So now I will explain more about the futures product itself. As I mentioned earlier, futures is basically derived from the underlying asset. Okay, so it's basically an agreement between the buyer and seller on a price today for a delivery or settlement in a future date. So as I mentioned, it's a price anticipation. In a way, in essence, you can say that how the price would be traded on the settlement date or on the delivery date for commodities. Okay, it's a standardized for the agreement, so the contract size and everything is all products are listed. So for your reference, you can actually go to the all the exchanges to look at the contract specifications, and it's a good way to give yourself exposure into all these various financial instruments such as stocks, currencies, and commodities. And finally, as I mentioned previously, it's a great vehicle for investors and also hedgers alike to manage their risk. Okay. So as I mentioned earlier, there are three basically participants, so to speak, in the futures market, which are the hedgers, the speculators, and the arbitrageurs. Okay, hedgers are basically people that are in the underlying market itself. So for agriculture, let me give you an example. Just say if you are Petronas, all right. So you deal with the petroleum itself. So how do they use futures to hedge their position? Example is because, as you know, the price of crude oil, especially of late, has been very volatile since the MCO. So to mitigate risk, what they do is they would actually hedge into the futures market. So since they are a producer, they will obviously sell forwards in the futures market to lock in their pricing based on their own pricing mechanism. And also for some of these financial institutions like fund managers and whatnot, because they are exposed in the cash market, the stock market. So to mitigate their risk, they sell into futures or buy into futures depending on the position to manage this to manage their portfolio. Okay. Next on is the speculators. Okay, speculators is basically, I think, the most of us listening in today. So we are basically trying to capture the price movement, whether it's on the upside and downside, for us to make a profit, so to speak. Okay. Predominantly, speculators would be the retail participants in the market. Okay. And finally, the arbitrages. Okay, this is a bit more sophisticated. That there are people that actually invest in where there's a price discrepancy in the market. So, for example, if as you know, okay, for index, there's a premium and discount. Premium is when the futures is trading at higher than the cash market, that was the stock market. And when there's a discount, it's trading below the stock market. So whenever there's a large difference, for example, usually above 1%, so assuming the market now is at 1500, so if there's a 15 points, if the market is trading above the cash market, the stock market, there might be opportunities for these arbitrages to, in a way, lock in their profit. So they basically would buy, example, they will buy the cash market, the stock market, and they will sell the futures because there is a big premium on the futures end. So they more or less lock in this 1%, and it's essentially risk-free, I would say, with inverted commas, but it's not that simple where, you know, or just where there's a 15 point where the premium you just sell. There's obviously all these indexes are index weightage. They have a certain, firstly you have to look at the component, what are the stocks that are in that index, and their individual weightage. And there's a sophisticated formula which they use that they will take into consideration beta and whatnot, and based on that they will arbitrage. Okay, but I will not touch into that because we are still this webinar is basically introducers a webinar. Okay, next on we are moving on to advantages of trading futures. Okay, futures is basically a leverage instrument. So when you are trading futures, it's essentially there's gearing involved, but I think as with all investments, everybody wish to put in the minimum amount of capital to get the maximum amount of gain. So, but when you trade futures, this allows you to do that. Okay. Secondly, futures market is very liquid. I think in terms of liquidity, there are a lot of market participants because, as I mentioned earlier, there are like hedgers, arbitragers, speculators. So the liquidity is definitely there in the futures market. Commission and executional costs are low. Okay. For futures, basically, it's a flat fee. Okay. So it depends on the product you trade. There's a monetary amount. Whereas I think if you are trading into stocks, in Malaysia, there's a certain percentage of the value you have to pay. But Malaysia is basically a flat rate, and it's regardless of the current notional value of the underlying of the futures product itself. Okay. Okay. Next one is speculators can tend to make money faster, but this ties into my first because it's a leverage product. But having said that, also you have to manage your risk wisely, because as you know, if you can, a lot of people, my clients ask me if I can make money faster means I can lose money faster also, right? So I would say yes and no. Yes, in the sense that if you do not manage your risk well, then you'll be facing that problem. But if you can have good system in place, then obviously it will be opportunity for you to make some profits. Okay, and finally, futures is a great way to diversify your portfolio. Okay, because if you look at the APEC pyramid of investment, right? Futures, derivatives, all these leverage instruments will fall at the apex. So generally speaking, obviously you will have your cash FD, your stocks, your bonds and whatnot, but futures will be probably a rough gut line will be about 5 to 10% of your entire total portfolio. So it's a way to essentially diversify your portfolio. Okay. Moving on, now I'm going to do a brief comparison between futures and equities. Okay, so when you trade futures, you're actually buying or selling something in the future at an agreed price today. Okay, so this is the key principle of futures. Whereas if you are trading equities, when you buy a share or stock of a company, you're basically buying ownership, a small portion of that business. Okay. Next is margin. All right, this margin is one of the fundamentals of futures. For you to trade in the futures, product, you need to deposit a margin. So generally speaking, it varies depending on the product and the volatility between 5 to 20%, okay, which ties back into your gearing. For equities, basically, it depends if you are using share margin financing. Obviously, it will depend on your ratio and your agreement, but essentially, you basically have to fork out if you are picking up the stock as a whole. You are basically putting in the full value of it, okay. Another very interesting aspect of futures is short selling. Okay, as you know, on the futures end, you are permitted to short sell. Okay. Whereas if you look into for Malaysian equities, I think it's there's a lot of restrictions, and generally I would say you are not allowed to short sell. There are certain criteria with conditions which allows you to. But having said that, as I'm sure you are aware, since the implementation of the MCO, the regulators has even been more strict on this ruling of short selling the market. So, but for futures is no issue whatsoever. You can short sell all futures products. Okay. So the next thing that we are looking at is timing. Timing futures is basically based on expiration date. Okay. So it varies. Futures contracts are basically based from month to month. So generally speaking, at the end of that period of that month, the contract will expire. Okay. Whereas if you buy a share, basically it's perpetual ownership. Equities, you can actually just hold the stock until, assuming that the company is still afloat, then you will be able to holding the stocks of that company. Okay. This is an important point to note. Risk of loss. Okay. When you trade futures, there is a possibility of what we term as overloss. Okay. Some of you might be asking me, what do you mean by overloss? Okay. Let me give you an extreme case, right? Assuming that you put in a particular margin because you're paying gearing, just say 10% of the value of the notional value. If for some unforeseen circumstances, there's a natural disaster, or let's say, hypothetically speaking, there's a terrorist attack on one of the major cities in the world, and as a result, the following day the market crashes. So if you are holding a long position in the index, the drop of the index the value might actually be more than what the margin that you have in the account. So in this case, we have to, as brokers, we are obligated to tell you there is a possibility of overloss. However, we have a lot of systems and mechanisms in place to mitigate this issue. Okay. But as for your equities, basically you can hold your stock value until it goes to zero. As long as the company doesn't bankrupt, you are basically good to hold that stock. All right. Now moving on, why should you trade futures? So it goes back to ties up with the previous point, leveraging. Okay, as I said, minimum capital, maximum profit. So this it allows you to do that. Then diversification. Once again, diversify your portfolio. Low transaction costs, as I said, monetary amount is a fixed value. You just have to pay that fixed fee. And then two-way entry, long short. This is basically a summary of what I said previously in the previous slides. And protection and speculation for hedgers, and also for the speculators to maximize profits in the underlying asset. And also standardization. As I said, there's always this contract specifications which are all published on the exchange, and also if you require, we can provide it, so you know exactly what we term as the contract specs of that particular futures product, right? So now I will be touching a bit on the CME products. Okay, what is on offer by their exchange? Just to give you some examples. All right, so as you can see, it's actually quite a broad scope of products which they have. Basically the five main asset classes would be equity derivatives, precious metals, financials, energy, and agriculture. Okay, but in Malaysia, we have, I think, a lot of our customer base in trade the mini Dow, gold, and some precious metals. But the financial derivatives not so much so, because at this time we are still generally more retail centric. And obviously, crude oil is a popular one, with some people trading into agriculture, this soybean futures and soybean oil, because they are somewhat hedging or arbitraging their position in our local Bursa Malaysia product, which is crude palm oil. Okay? So this is just basically an illustration to show you all the products which are encompassed within the different asset classes. Now I will go specifically into one particular product, which is the E-mini Dow Jones. Okay. Okay, what is to give you a brief breakdown of this futures product, is basically is a good way of exposing yourself into the Dow Jones the industrial average. See, when you buy an index futures, you are essentially buying into their component index, which and based on their weightage of that particular futures product. So for Dow Jones, it tracks the 30 largest companies in all the leading sectors within the US economy, and this forms the Dow Jones Industrial Index. All these are the list of which I will show you later. So instead of buying 30 different stocks, a way to actually circumvent it is to actually buy one index of the Dow futures itself. So essentially, when you buy one lot of Dow futures, you are already buying the top 30 counters in the US markets. Okay. This product is traded nearly 24 hours a day. Okay, there's a short break which later I will show you within the contract spread itself. And so, as I said, it allows people to hedge their position if if they are trading into US stocks as well. So this will be quite a important tool for them to actually use. Okay. Moving forward, this is actually the contract specifications. This was what I've been telling you earlier on. So the contract size, because it's a mini contract size, is in the $5 denomination. So basically, one index point of the Dow Jones is equivalent to $5 US. Moving on is the contract month. So basically, for this, as I mentioned, it's futures are traded in months. So for example, now it's September. So there will be the spot month, which is September. The next month will be October, and then after that it will be every quarterly month. So the next quarterly month is December. So if you look into the active months, the traded months for this mini Dow, it will be September, October, and December currently. Okay, so settlement type is cash settle. Okay, so at the end of on the expiry date, there is the calculation which will be generally which will be done and announced by the exchange, and that will be the final settlement, and everything will be cash settled. Okay, so it's a P&L basically based on a P&L. Okay, and then the final trading day, these are all the last trading day for that particular contract month. Okay. Now, as I was mentioning earlier, when I said it's almost 24 hours, there's basically for Malaysia, there is it trades from 6 until there's this 4:15 a.m. Basically, because the Dow Jones closes at 4 a.m. our time, but we trade additional another 15 minutes. So essentially, at 4:15 it closes lah. Okay, so there's what the exchange terms as maintenance break, and then throughout the trading break, there's another half an hour break between 4:30 a.m. to 5 a.m. So generally, that these two breaks within the 24 hours. That's why as I said, it's basically more or less 24 hours. Okay, moving on. These are the components counters of the Dow Jones Industrial Average. So as you can see, these are all the big boys in the big companies, the Fortune 500 companies in the US economy. Okay, I will not go through this with you. I think as and when you have time, you can just basically have a look at this. Okay, so obviously, what are the factors that would actually move the Dow? So these are the key data, the key information, the economic data, or the inflation, jobless claims, and whatnot. And also, definitely, I think similarly to Malaysia, also everybody would look at their corporate earnings, especially of the Fortune 500 companies. Also, another key area which I think also the investors look into is the FOMC, the Fed announcements, and if there's any change in monetary policy. Okay, currency, whether the US dollar is healthy or not, I think would definitely be another factor in influencing the Dow Jones. and followed by geopolitical and supply and demand of the industry in general. Okay? Next, okay, all these I'm not going to run through this with you, but these are generally all the key data that we use, and we actually provide information on this to our clients. So we actually send it out. So they're based on the anticipated and the actual. So it basically allows you to gauge and make an informed decision on how to trade the market. Okay. Next, moving on, we have covered just now the indices. Now we are moving on to energy. These are the bucket of components which fall under this category. So for illustration, I will use the crude oil, WTI, West Texas Intermediate Crude Oil Futures. Okay. So basically, it's one of the most active liquid, I would say, besides Brent, traded futures in the world. Okay. So it's electronically traded, and the term basically they use the word light is because of the low density and sulfur content. So ultimately, it's a high grade oil, and unlike the financial indices which are cash settled, most these commodity based futures are actually physically there's physical deliver for it. So there's an option for these people that are in physical market to actually do or take delivery. So in the case of this WTI crude oil, it's based in Cushing in Oklahoma. Okay. Next, we have now we go to the contract specs of this crude oil. So the underlying is basically WTI crude oil. Contract size is basically 1,000 barrels, which is equivalent to 42,000 gallons. So per barrel, the minimum price fluctuation is at 1 cent per barrel, which is equivalent to $10 per contract. It's traded all months. Okay, usually it runs up to can run up to 2 years. Okay, but generally the more actively traded will be within the first year of spot for that for the crude oil. Okay, similarly, okay, what there's this additional thing which I've added: speculative position limit. Position limit is generally, I think, is set by the exchange, but for most retailers, I think we will never reach that particular the size of open position. With regards to trading hours, is similar to the just now the Dow Jones futures, with the two intermittent breaks at 15 minutes and 30-minute break on the Globex trading platform. So this is generally just a quick the summary of the contract specs for the crude oil. And as I said, this one I will not elaborate. I think because I have 50 over slides, so I will just some of this I will focus on the key areas to share with you. But I think the slides will be shared with all of you later, so you will have access to the slides. And these are certain extra information if you wish to delve more into that particular product. You can most welcome to have a look into. Right. Next, more information. So basically, as with all commodities, it's based on demand and supply. So this is just a list to illustrate the top producers and the top importers of the crude oil. Next, okay. Commodities and indices are very different creatures by nature, so to speak. So for all commodities, I think the primary movement will be based on the demand and supply issue. Okay, so these are the two points which I've highlighted on top. And then obviously the factors like for crude oil will be OPEC, the oil producing countries. They basically, I would say, they have a very strong influence on the pricing of the crude oil itself. Geopolitical issues such as if there's war, and particularly in areas where there's a lot of these oil rigs and extraction of oil. Environmental issues, whether there's pipe leakage or whatnot. In summary, these are all the list of factors that would actually affect crude oil. Okay, as I mentioned earlier, something that you can look into on your own time, right? And these are the data which will be influencing the price. As I said, all this information actually we do print it out and provide it to our clients, so you would have access to it and you can digest that information and draw your own conclusions whether or not to long or short the market. Okay, now we move on to the next major section, which would be actually, I would like to share some basic trading strategy, okay, on how do you actually trade this futures product. So I will start off with using back the mini Dow 5 for this illustration. So there's scenario 1 and scenario 2. Okay, so for scenario 1, let's look at the bullish benefits of a bullish market. Means you are basically going to long or buy into the market. So let's assume that the market now is trading at 26,200. Okay, so in anticipation, if you are bullish, you will definitely buy into the futures the E-mini Dow futures at that current price of 26,200. Okay, so assuming that it is in your favor and it goes up to 26,550. So basically there is a gain of 350. So what you do is, since you long, you obviously have to close your position. You will short into the market at that level of 26,550. So your gain, because the one index point is $5. So your gross profit would be the $5 times the 350 index points, which basically is equivalent to 1,750. So this is your gross profit. Okay, and on the other side of the coin, this is an example of your bearish. As I mentioned earlier, you can short sell the market. So if you think that crude oil is going to come down, you're allowed to short sell into the futures product. So assuming back at the similar level of 26,200, you short, okay, you short sell one lot and it drops to 25,850. So based on that, when it comes down to that level, what you do, you have to buy back because you have short. To net off your position, you have to buy back. So essentially, you have also you have made a gain of 350 points. So it's 5 times 350, which is 1,750, right? This is actually just an illustration again, similarly to crude oil. I think I will not, due to time constraints, I will not go into the finer details, but essentially it allows you, if you are bullish, you can long the market. If you are bearish, you can basically just short sell into the market, and whatever calculation will be based on the contract value, the tick price, and you will make that a respective gross profit or loss as an outcome of that trade. Okay. Next, we have, okay, this is I think a very essential, important part about futures, understanding margin. I will spend a bit more time on this because I would like to just to shed more light on this. Okay. Firstly, initial margin. Okay, so what is the initial margin? When you have initial margin, basically it's a good faith deposit which you place with the broker. So for example, if you are trading with us, you will place an initial margin with Kenanga Futures. Okay, it's also known as a performance bond. Okay, and then we have another term which is maintenance margin. Okay, for this is more prevalent in the US markets, where after you have deposited an initial margin and the price starts to fluctuate, there is a minimum amount that needs to be in the account for you to hold that position. Okay, so that is considered as a maintenance margin. All right. Now, margin call. What happens when there is a margin call? Under what circumstances? So when you receive a margin call is when your margin, your equity falls below your maintenance margin. Okay. So for us, basically you are required to top up and or liquidate your position by T+1. Okay, this I will elaborate further in the next slide. Okay, but now the bit more terminology which is used in the margin concept is margin requirement. Okay, how much margin do we charge for a particular futures product? Okay, it varies from exchange to exchanges. Typically, it can be as low as 2% or to be as high as 20% of the full contract value. As I mentioned, when you trade futures, there's the contract spec value, but you're only paying a portion of that value, which varies, which gives you that gearing. Okay, so this is the margin requirement is set by the exchanges. They have their own formulas of counting it, and these are published. Means they publish it on a website, and as a broker, we will inform all our clients what are the margin requirements. Okay. Now, next, another term which is also used is post liquidation margin. All right. Generally, good practices are when your account, when the equity, when your balance falls below 20%, the broker reserves the right. I'm not saying that we will definitely liquidate, but we have the right to close off your position. Means we can force it. If in terms of shares, we can force out your position. So for futures, we will we call it FF, we will force liquidation based on your margin. Okay. So to offset or neutralize that, you can either top up margin or you can liquidate some of your position, if not all of your position. Okay. Moving on, this is just a summary. Apologize, it's a bit small because I'm trying to put in as much information as possible. So these are basically the margin requirements for the futures products. Okay. So example, if you look at this, for example, just now we were mentioning this, just say crude oil. So now it's at 6,820. All right, this is your initial margin, US dollars. This figure is based as of today, based on 17th of September. So it doesn't change that that often, to be honest. But sometimes if there's a long stretch of holidays or market is very volatile, they will revise the margin, and we will inform our clients accordingly. So this is something that we send out every day. So you just to keep our clients in the loop as to what the margin requirement is for the futures products. Okay. Moving on now, I will go on to the finer details of giving you an example of how margin call works. All right, let's assume that you're going to trade in down. Okay, your initial margin means your deposit with us is 12,000. All right. Let's assume that the price is at 26,200. All right, and you basically on the first day itself nothing happens. Just say hypothetically speaking, it expires at this level, so you're full 12,000. There's no margin call. Okay. Now, come the second day, assuming if the market goes up by 300 points, all right? So 300 points times 5, you get that 1,500 here, all right? So now you're on that day, your equity is 13,500. So it's your initial 12,000 plus your 1,500, which comes up to 13,500, all right? This day two. Now on day three, the market is not in your favor. It drops 330 points, okay, to 26170. So the account will be debited by an amount of 1650 based on 330 times 5. So now your equity balance is 11,850. All right. So assuming the initial margin is 12,000, right? Now you are below that margin. So you need to top up margin of 150 the next day. So this is the T plus one, the margin top up, which I was talking about earlier. And then subsequently on the fourth day, assuming market goes back up and whatnot, then obviously your equity will go back up and then you will have no call. So this is just a very bare knuckle calculation for you to understand how this margin concept works, right? Moving on, so this is the summary table of what has transpired on top. So I've summarized for you the actual calculation that has taken place, all right, based on the day-to-day trading for the past 4 days for this sample account, right? All right, now that I have covered margin, I would like to talk about basically risk management strategies. Okay, so as I think the most important thing is the golden rule. You have to plan your trades, okay, and you have to have firm stop loss and profit taking points. I mean, the general consensus everybody know is to cut loss and net profit runs, but unfortunately, I think based on my 20 years of being a dealer broker, the situation is unfortunate where it's the opposite. Right? So you must have a plan, you must have a strategy in place, and more importantly, you must be able to execute it. All right. This one is another one of the various methods which can be used. Is we call the 1% rule. Okay. Basically, you do not risk more than 1% of your capital. But for futures market, I think it's a bit difficult because due to volatility, I would recommend about 2% of your capital. I'm not talking about invest your capital that 1 or 2%. I'm talking 1 or 2% in the terms of the risks you are willing to take in your single trade per trade. Okay, so this is just one of the very general rules which can be applied. Okay, and then following on stop loss and profit taking points, I think you have to be firm on this. So obviously, we will use key indicators like support and resistance level. In fact, we actually do in our commentary provide some of this information. That will be at the end of of these slides. I will share some samples with you. Okay. And finally, it's also diversify. As I mentioned, don't put all your eggs in one basket. So generally, the more diversified your portfolio is, the more the risk you are able to mitigate the risk of your investment portfolio. Okay. Now I think, oh, good. We are almost I'm just on time. It's almost 8:15. So just a brief information about who we are as Kenanga Futures. So now most importantly, we would like to highlight that we are actually we don't only do CME products. Obviously, we also trade Bursa Malaysia derivatives, and we also offer access into the Hong Kong exchange. So there's a list of all these products which are being offered. I think previously, if you refer to the slide which I mentioned, the margin, all those are the products which are being offered by us at the moment. All right. So CME products, all the asset classes, these are just examples. BMD products, we also cover all the futures that are offered by the exchange. And then, okay, this is basically okay. I have to do this a bit of in-house selling. But having said that, this is a sample of the daily commentary which we provide. Okay. Okay, so if you can look at it, unfortunately it's a bit compressed, okay. But this is generally the commentary which we will send out every day prior to market opening to all our clients. So these two examples are basically our local FTLI, our local index, and also our crude palm oil. And then in addition to that, we also have market reports and updates, whether it be quarterly, biannually, or annually. We will share. We have some spreadsheet, fact sheets, and whatnot. These monthly, quarterly reports for you to actually have a look at. We provide this as well. And then, okay, now in terms of our trading platform, we generally have our trading platform is called KDF Trade Active. Okay, so basically this is the online platform which you can use. We also offer an app-based, which is KDF Mobile. So depends on your own personal preference. You can actually trade with us through this platform. Okay. And all right, so I think this basically, if you have any interest in trading with us, you can you're most welcome to contact our BCRM for more information on how to actually trade. And I would like to also highlight that now we are currently having a promotion, basically on not promotion, but we're having a campaign from the 1st of August until the 31st of October as a thought into the future. So it's a good time for you to actually join us, sign up and trade. And I think that more or less ends my webinar session for today.
Edwin, is there anything else you would like to add on before we end the session?
Yes, basically, I would just like to thank everyone for listening in today, and I hope this webinar has been informative to you. And definitely, please do reach out to us through the email if you have any more questions. We'll be more than happy to help you answer them. That's it. Thank you.
All right, great. Thank you, everyone. Should you have any further queries, please feel free to post your question and email us at bcrm@kenanga.com.my. We appreciate you being here and hope that you enjoyed the webinar today. Please take a minute to rate our webinar, and your feedback is highly appreciated. Again, don't forget to register for our next webinar. Thanks again for joining us and hope to see you again in our next event. Stay safe, everyone, and good night.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.